Hello everyone. Good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier sessions, we discussed about estimation of working capital requirements and also solved some of the questions related to that. Definitely, it's quite possible that a 10 marks question on that can be expected. Another possible 10 marks question in this chapter of working capital management is cash budget. So let us quickly go through some of the aspects related to treasury management and also how to prepare cash budget. We'll discuss in the current session. Of course, like any other topic, it has a lot of theoretical aspects as well, and questions can be expected from them also, theory questions. So this cash management or treasury management is one of the very important wings of or departments of any organization. Particularly bigger organizations will have a separate treasury team. Smaller organizations, mostly the finance manager himself or herself will be handling the treasury also. But what will be the treasury management doing generally? Of course, part of the working capital management and financial risk management also, including foreign exchange and interest rate management. How this is done in relation to foreign exchange, etc., and interest rate management using various derivative instruments, those things will be learned conceptually and practically much in detail at the final level. But in general, what are the goals of the treasury function? This can be a question. What are the goals of treasury function or treasury management? Maximizing the return on the available cash. So the cash that is available should not be kept idle. It should be naturally invested. And usually the investment will happen in the marketable securities, that too in the debt instruments, sometimes called as money market instruments also. In the short term financial instruments, this cash will be generally invested, and so that the cash is not idle, it is also making some money, but at the same time it should not be too risky also. And on the other side, the idle cash should be invested so that it gets better return also. So once again, the trade-off between risk and return is one of the functions here also. Like any other case, liquidity versus profitability, like that in any of the other decisions related to capital structure or dividends, everywhere balance has to be maintained. And here treasury management also tries to balance the risk associated with those investments and the return that is coming from those investments. But once again, point to be noted here just for understanding now is these are all short-term investments in the money market or any other short-term financial instrument. And another key goal of treasury management will be to minimize the interest cost on the borrowings, because naturally any organization requires certain funds, both long-term and short-term. Long-term funds is of course handled as part of the overall capital structure, and associated cost of capital to that will be assessed at a strategic level. But the borrowings normally which are taken in the form of working capital loans, on that better interest rates have to be negotiated, and that will be done by the treasury function. And mobilizing as much cash as possible for the corporate ventures for maximum returns. So naturally mobilizing the cash, mobilizing the funds is one of the key goals of treasury management. And other things including dealing in the foreign exchange or foreign currencies, particularly for multinational organizations, that becomes very important. And dealing in money markets and commodity markets if required, so that risks can be reduced. Usually that is done by using derivative instruments. So what are those and all will be dealt in final level. So but just to note, the risk mitigation or hedging the risk, that's called hedging. So that hedging of risk generally happens through derivative instruments. And because there will be risk associated with any market, whether it is forex market, money market or commodity markets, the prices of commodities and the interest rates related to money. Interest rate is nothing but the price of money, and foreign currency rates, exchange rates keep on fluctuating, so that automatically it involves risk. So much of fluctuation is always risk. But how to mitigate that risk? Can that be completely mitigated? Not possible. Can that be managed? Yes. How? By doing this process of hedging through derivative instruments. That is on one side. Sometimes it can be even giving profitability to the organization also. Sometimes. But that will be generally happening when whatever the estimation of the treasury manager in terms of the market fluctuations becomes true. Every treasury manager will have one estimate about anything, whether the foreign currency will become stronger or weaker, whether the interest rates will go up or down, whether the commodity prices will go up or down. Some estimation will be there. Every person in the world will not have the same estimation. If everybody has the same estimation, the markets will not work. So some person will estimate that the prices will go up, and some person will estimate the prices will go down. Both are qualified, both could be chartered accountants, both could be CFAs, but still their estimations will be opposite. But who gets this profitability ultimately is the one whose estimate has become reality. Whoever it is, one of them will definitely get that profitability. Such organizations will gain also out of this process of managing funds through many types of markets, including forex markets, money markets, and commodity markets. These are all the various key goals of treasury management. And the same things in a little detailed manner are given. What are the functions of the treasury management? One of them is cash management and currency management. Currency is here foreign currency generally. That's what we are talking. That is more important for multinational organizations. Fund management is about fund. Whenever we say normally, it refers to working capital. Usually, whatever the working capital requirements are there, those have to be managed well. But mostly related to the short-term needs of the funds are related to working capital. But also the treasury has to plan for medium as well as long-term cash needs of the company according to the requirements of the company, naturally by managing inflows and outflows, by mapping them. Will that exactly match? Never possible for any organization. Inflows and outflows will not match exactly. So what happens? Definitely there will be some surplus sometimes, or sometimes there will be some deficit. Surplus has to be invested, deficit has to be borrowed. How that has to be done? That is also part of the treasury management. So cash management, currency management, fund management, banking, all the banking function generally lies with the treasury management. Also some of the corporate relations, corporate finance operations, including investor relation type of situations, will be done by treasury management. But of course, most of the organizations, they'll have a separate department for this. Usually the treasury function is not burdened with this. Again, depends upon the size of the organization. If the size of the organization is smaller, more and more responsibilities will lie with the same person. If the size of the organization is bigger, the specialization will become more. And where huge multinational companies and banks particularly, they have a treasury team that is a very sophisticated and very dedicated team. They will be working only on the management of currencies, banking operations, fund management, and cash management. These are the major things that they do. Corporate finance is generally left to some other department. It's okay. Depends upon type and size of the organization. Now, what is this cash management? Whenever we say working capital management, that includes the management of current assets and management of current liabilities. Current assets include cash. So, managing cash is also part of the working capital management. That is why this chapter is here. It is one of the important functions of the finance manager. Of course, it is not a strategic function. So far, in this subject of financial management, most of the things like cost of capital, capital structure decisions, investment decisions, dividend decisions, those are all strategic decisions. Whereas management of working capital is a day-to-day operational level requirement. So that is also one of the functions of the finance manager. And definitely, when we say cash, that should include bank also. Don't take too literal meaning for cash. Cash is different, currency is different, bank is different, all of them are different. Yes, they are. But ultimately, whenever the word cash is used, we include all of them. But what are the things that will happen? Naturally, cash flows will have a flow into the organization or out of the organization. And there will be cash flows within the firm also for across various departments, across various branches. That is possible. And just now, as we discussed, cash balances will have to be invested. And if at all there is a deficit, how to finance that deficit has to be also managed, and it has to be decided by the treasury manager or finance manager, as the case may be. So these are the main points here. What are the final objectives of the cash management? Simply same things, providing adequate cash to each of the units as per the requirements. So let us understand cash, something like liquid. Of course it is liquid. It can be considered as water also. Water is also liquid. If you consider the organization as a body, cash is the blood, and that blood has to flow to every organ of the body. If it is not flowing to any particular organ of the body, then that organ will not function properly. So naturally, it is the heart of the organization, we can say, which pumps blood and purifies it. Of course, that is for biological purposes. As far as treasury management or cash management is concerned, its job is to make sure adequate blood is pumped. Blood here means cash, that liquidity is provided to each of the units as per the requirements. And second thing is, no funds are to be blocked in idle cash. If the funds are blocked, if there is no flow of them, just idle cash is there, that is also not a good sign. Lot of multinational corporations right now are sitting on huge piles of cash. They don't know what to do with that. So much of cash is there. And that's not something very good also. What does it mean? It means that the company does not have any ideas where to invest also. So it has almost already reached a saturation level. So it's not a growing company. Usually growing companies will not have any idle cash. They'll be requiring more and more cash. But already stable companies will have idle cash. Generally, it is not considered to be a very good sign. Too much of idle cash blocked also is not good. At the other side, if the cash requirements are not fulfilled, that is also not good. That is where the balance has to be maintained. And the surplus cash, whatever it is, if at all, that has to be invested in order to maximize the returns for the business. These are the same things, main functions of cash management or treasury management, whatever we call it. Of course, always, like any other management, within the part of financial management, there has to be a balance that is maintained between liquidity and the cost. Both of them have to be balanced. Too much of liquidity means too much idle cash. That involves opportunity cost. That is also involving cost. Very less liquidity means that is dangerous. That will be probably forcing the organization into bankruptcy also if it is not able to meet its short-term obligations. Both ways, these things have to be managed well. And another theory question, of course, this can be asked in EFF also, which is there. What are the major considerations for determining the amount of cash or liquidity? This can be true for organizations also, for sometimes even for individuals also. What are the purposes for which the cash is held? What is the need for cash? Keynes has already proposed it. The needs of people for the cash, why do they prefer cash, is for the transaction motive and speculative motive, and sometimes precautionary motive. The people will keep cash. That is a need for cash. Three different things. It can be a short note question, either in FM or even in economics or finance. This is there already in that. And cash planning is what? Cash planning simply is about knowing cash budget. What is that? In this syllabus of intermediate level, preparation of cash budget itself is cash planning. That's what has been demonstrated here. What is a cash budget? Cash budget is basically the budget related to the cash inflows and outflows, of course related to the future period. Budget itself is always about future. So what is the possible cash inflows and possible cash outflows will be depicted in a cash budget. So just understand this way, we know how to prepare a cash flow statement, but that was related to the past. Cash flow statement was related to the past. But on the other side, cash flow statement has a particular accounting standard 3, which tells how to prepare the cash flow statement, which means you cannot do anything else other than what the accounting standard says. Whatever the accounting standard says, you have to follow that. That format has to be followed. Investing activities, operating activities, financing activities, all of that has to be followed. No option. So that is more of a compliance requirement than a planning tool. What about the planning tool? That is cash budget. And this is not related to past. This is related to future. And definitely it will help the organization in coordinating the timing of the cash needs and identifying the periods where there could be an excess cash, or sometimes there could be deficit also, and also to take sufficient cash, if at all some firms have, that can be taken as advantage for obtaining cash discounts on the accounts payables. Let us say you have sufficient cash, and if your creditors are offering you cash discount for paying early, why not take it? So that decision can be taken also, part of the payables management, when the sufficient cash balances are available. Like that, it will help to plan or arrange the needed funds. Main purpose, ultimately the main purpose is this: trying to avoid excess or shortage of cash. Trying to avoid. It is impossible. Every organization will have monthly, if at all, if you prepare. So for some months there may be excess cash, for some months there may be shortage of cash. But do we know it? Or we are just following as the month comes, money is coming, going out without our knowledge. That is not good. That is why budgeting is a very important activity. Of course, most of the budgeting related to the operational requirements was discussed in costing in the form of preparation of sales budget, production budget, procurement budget, as well as consumption budget. Those are all operational functional budgets, and master budget related to the budget period. This is also a part of that. That is cash budget. This can be there in costing also, or even in financial management also, because already in costing there is a more scope of other budgets being asked in the examination. Usually this cash budget is a very favorite question in the group 2 financial management. So that is why this becomes a very important topic. So what will be the various aspects related to the cash budget? Simply the inflows and outflows. We don't need to really get into too many complicated things here. It's very simple and straightforward activity. Only thing is you need to read the realities where those are given in the question. Those are given in the question, and those have to be identified carefully, and accordingly we need to prepare the cash budget. And this can be prepared in different ways. Receipts and payments method, which is what we are going to mostly follow, and even that is what is most commonly followed by the organizations also. Means cash inflows and outflows. What is the balance? Simple. So opening balance, add receipts, deduct payments, closing balance. Simple. That's what is receipts and payments method. It is prepared like a statement, not like an account. Next, adjusted income method and adjusted balance sheets methods can be also used. In fact, whatever you did already in the cash flow statement preparation is adjusted income method only, because income is the starting point of the cash flow statement. Net profit as per profit and loss account. That will be adjusted with many items, like non-cash items are being eliminated, like depreciation, etc. So like this, adjustment of various items from the income statement or from the balance sheet can be both of them together also, because in the cash flow statement preparation you need to know various changes in the working capital. If you remember, that has to be also adjusted, where from those details will come from the balance sheet. Everything will not be in the income statements. Increase or decrease in debtors, increase or decrease in creditors, all those things will come from balance sheet. So both income statement and balance sheet figures, if they are given, then we can prepare cash budget from them. Your accounting knowledge will be useful for that, whereas for the first method, receipts and payments method, it's all common sense. No special knowledge is required. What will be the receipts, what will be the payments, we can see that. I mean, there is no need to know them or by heart them. What will be the list of receipts? There could be anything. Majorly what? Majorly the receipts could be coming from customers, that is collection from debtors. Sometimes cash sales also possible. Maybe some bank loans are taken. If share capital is issued or something like that, that is also an inflow. Some other receipts could be there. These are all receipts, simple things. Then what could be the payments? Major payment for the regular purposes will be payment to creditors and wages and other expenses, overheads. Interest could be an expenditure and payment also. What are we bothered about here? Payments. Be very clear. We are preparing cash budget. It is not accounting that we are doing. We are talking reality. So accrual concept and all will not happen. We have to follow the cash concept. Real receipts, real payments only will come here. Dividend, tax, if at all paid. Any capital expenditure also will be the cash outflow. All these items will be outflows. Like these inflows and outflows are taken. Opening balance is there at the beginning. Add inflows, deduct outflows. Naturally, the closing balance will come. Difference will be the surplus or shortfall. If it is a plus item, then it is surplus. If it is negative, that means it is a shortfall. And whatever the closing balance of some period 1 or month 1 will become the opening balance of month 2. There is nothing special there. That will be Also a commonsensical point. So cash budget preparation is a very important thing, and definitely questions can be expected and very clearly given here also. Students are required to do good practice in preparing the cash budgets, and that is going to be a possible question for 10 marks. It will not be complicated, it will take time. So how can we reduce the time taken by this? Only with practice. And also reading the question carefully is very, very important here, because every point has to be implemented by us in the actual answer. So let us prepare this cash budget from the information. So prepare monthly cash budget for 6 months beginning from April 2020 on the basis of the following information. So from April onwards, 6 months cash budget is asked here. So first thing first, 6 months will be what? April, May, June, July, August, September. 6 months. Okay. Next. The inflows and outflows will not be directly known. If they are known, copy, paste, adding, deducting, anybody can do. So from the available information, we should find out the inflows and outflows. For that, of course, you require working notes. So here, estimated monthly sales are given. This is sales. Sales does not mean receipts. Not necessarily. Because credit sales will be received, but not in the same month. They may be received later. So like that, for January, February, March, April, May, June, July, August, September, October, all these months, sales are given, not receipts. We have to get how much will be receipts from this information. For that, we need further information. From sales, we cannot say they are directly receipts. No, they are not. And wages and salaries are estimated to be payable as follows. This is okay. These are outflows for sure. They can be taken as they are, copy paste only. Then coming to the actual point, main point here will be the collection from debtors and payment to creditors. In any cash budget, these are the only two major things. Remaining things will be straightforward. Of the sales, 80% is on credit, 20% for cash. And 75% of the credit sales are collected within 1 month after the sale, and balance in 2 months after the sale. So that is the collection pattern, and there are no bad debt losses. So everything is collected. So that is the point here. So how to get collection from debtors is one part. But prior to that, we can get cash sales for sure. That is direct. Cash sales can be taken directly. How much cash sales are? 20% are cash sales directly. So we are talking about the final answer here. So this is cash budget. Anything else will be in the working note. So naturally, first we should start with the opening balance. Receipts. Add receipts. What will be the receipts? Generally, collection from debtors and cash sales. If any other receipts are there, we will see that. Leave some space. Less payments. Or you can call them inflows, outflows also, no problem. Whatever it is. So add receipts, less payments. Payments, whatever, whenever they come, we'll see that. First thing first, what we can do, we'll do it. Whatever the things which are required to be done in little detail manner, we'll do them in the working notes. Now 20% sales are for cash. So what do we need here? We need cash sales. For which months? Only for April, May, June, July, August, September. So what will be the cash sales? 20% of which month's sales? April sales. 20% of April sales will be cash sales. April sales are how much? 80,000. So 80,000, 20% of 80,000. That is 16,000 cash sales in April. Like that for May, 20% of 60,000. For June, again 80,000. For July, course, you have to do it on paper. July, 20% of 1 lakh, 20,000. August, again 80,000. For September, 60,000 means 20% of that, 12,000. These are cash sales. One thing directly we can calculate from the information that is available. What about the collection from debtors? That has to be separately calculated. That has to be done in the working notes. So collection from debtors, how will that be? That has to be done separately. And be careful here. Collection from debtors, how is it happening? The terms have to be clearly understood. Of course, 80% of the sales of any month are credit sales. For any month sales, 80% are credit sales. That is first thing. And out of the credit sales, 75% of the credit sales are collected within 1 month. That means next month. And the balance in 2 months, that is after the next month. And there are no bad debt losses. So that is the first terms have to be very, very clearly understood. Of course, for that purpose, let us start with sales. So collection of April, let us say, will have March sales collection also. It will have February sales collection also. Let us say sales happened in January. If sales happened in January, 80% of that is credit sales in January. When that will be received? It will not be received in January. According to this, 75% will be collected within 1 month after the sale. So that will be received in February. And the remaining 25% will be received in March. But we don't want that. March collections, we are not interested. So January sales given, but not going to be helpful for us. Definitely from February onwards, it is going to be helpful for us. So February, March, April, May, June, July, August, September. September also is not required. Why? Because September sales happen, but credit sales of September will be collected in October and November. So we don't need that. We need only up to September. So this is our core period. For this purpose, we need the sales of many other months also. Let us just copy paste the sales first. 1,20,000. February sales, that is March 1,40,000. April 80,000. May 60. June 80. July 1 lakh. August sales we are just copy pasting. This is what you have to do on paper. August 80,000. These are the sales first. First thing first. How much of that will be credit sales? Let us take that first. How much of that will be credit sales? According to the question, 80% are credit sales. So 1,20,000 into 80% will be credit sales. Here I can do easily, but you have to do on paper. 80% of each of them has to be calculated. So those are credit sales. Okay. Then the collection pattern will be like this. What was told? 75% of the credit sales are collected within 1 month after the sale, and the balance in 2 months after the sale. So, for example, if collection of February sales, February credit sales happens when 75% happens in March. So let us put this 75 and 25 separately. 75% of February credit sales will be collected in March. What about the remaining 25%? They will be collected in April. Same February credit sales, 25% of that will be collected in April. Just for checking, total should be 96,000. So credit sales of February collection, 75% will happen next month, that is March. 25% will happen the next after the month, that is April. Like that, for others also you have to do. Like that, for March, 75% will be collected in April and 25% will be collected in May. Like that, April sales, 75% will be collected in May and 25% will be collected in June. Like that. May sales, 75% will be collected in June, 25% will be collected in July. Same way. June sales, 75% will be collected in July, 25% will be collected in August. Of course, September sales we may not need, but definitely collection we need. Same way, up to where we have calculated, up to June we have calculated. July credit sales, 75% are collected in August and 25% are collected in September. August credit sales, 75% are collected in September, 25% will be collected in October, which we don't need. So we can stop here. Up to September, these are the things that will be collected. So what is the total of the collection here? Simply, in each of the cases, that has to be calculated. So what is the total of the collection from debtors? 72,000, 1,08,000, 76,000, like that. But we don't need all March collection also. All that we need is from April onwards. March collection, we don't need that because we are preparing only April to September cash budget. So from April, May, June, July, August, September, these 6 months, that is a collection from debtors. That will be taken here, collection from debtors. That's it. That is the working notes related to collection from debtors. Done. Cash sales, done. Then wages and salaries already given. So directly we can take it as one of the payments. Wages and salaries. How much will be wages and salaries? As given, directly we can take that, copy paste. They are payable as follows given. So 9,000, 8,000, 10,000. 9,000, 8,000, 10,000, 10,000, 9,000, 9,000. 10,000, 9,000, 9,000. So that is wages and salaries payable. So that one payment is done. Sales we already have taken, and from that sales we have calculated cash sales also. We also calculated collection from debtors also. So far up to point number 3, we have covered everything. Like that, look at other point. Point number 4. Purchase amount to 80% of sales and are made on credit and paid for in the month preceding the sales. So whatever the purchases are, that is 80% of sales, and they are paid for in the month preceding the sale. Naturally, without purchases you cannot sell. So whatever the one particular month's sales are, in that 80% will be the purchases and they will be paid in the month preceding the sale. Like that, if you go back to the sales figure, sales we already have, but for this you need to have a separate working note. So let us take like that. Sales only let us take. How will that be? Sales, we have the numbers already. Now what is mentioned there, 80% of sales will be purchases, they will be paid in the month preceding the month of sale. We want the payment starting from April only, so we don't need others. We want the payments to be from April only. So let us take the sales of these things, September, and even October sales also we will require, because preceding the month of sale the purchases and payment will happen. So August 80,000, September 60,000. Earlier it was not required, now it will be required. October 1 lakh. These are the sales. Now purchases come payment will be what? 80% of the sales paid for in the preceding month. For example, in April, 80% of what will be paid, May sales will be paid in April itself. 80% of May sales will be paid in April itself. Same way, 80% of June sales will be paid in May. 80% of July sales will be paid in June. Same happens for other months also. So up to September, we have how much payment is supposed to be made. Exactly whatever is given, that only has to be taken. So this is the amount here. How much will be payment to suppliers, let us call it. Payment to suppliers. Again, 80% of sales paid for in the month preceding the sale. That's it. So April sales would have been paid in 80% of April's sales would have been paid in March. That we don't need. So we don't need this at all. Starting from May, if we take the sales, 80% of May sales would have been paid in April itself, and so on and so forth. That is the payment to suppliers. Then the fifth point says the firm has a 10% debentures of 1,20,000 rupees. The interest on these has to be paid quarterly in January and April and so on. So quarterly interest has to be paid. 10% debentures of 1,20,000 means, first of all, annual interest is 12,000. Right? When annual interest is 12,000, how much will be quarterly? So 12,000 divided by 4, that is 3,000. When it has to be paid? Quarterly, it said January, April and so on. So definitely in April, there has to be a payment. The main answer, interest. When should be that? In April, there should be an outflow, that is 3,000. 3,000 rupees should be paid. After that, May, June, nothing will be there. Again, when the new payment, next payment will come. July, another 3,000 has to be paid. Then for the next 2 months, there is nothing. Like this, the payment of 3,000 has to be made every quarter. In this particular 6 months, we had only 2 quarters. So those 2 months only, there will be such payment. 3,000 rupees interest. Next, also 6th point says the firm has to make advance payment of tax of 5,000 in July 2020. So let us call it advance tax. When is that? July. Exactly the month you have to check. July month. How much? 5,000. All remaining things, nothing, nil. Only in July there will be 5,000 payment of advance tax. Next, 7th point says the firm had a cash balance of 20,000 rupees in April 1st, 2020, which is the minimum desired level of cash balance. Any cash surplus or deficit above or below this level is made up by temporary investment or liquidation of temporary investment or temporary borrowings at the end of each month. Interest on these to be ignored. If any borrowing is there, on that no need to take interest. So what is the starting balance, opening balance here? 20,000. That is opening balance. So what has to be done? Of course, in the examination, you should have total of receipts and total of payments, and then closing balance will have to be taken at the end. Closing balance. So how to get closing balance? Simple. Opening balance plus total of receipts minus total of payments. That will give closing balance. So let us take the total of receipts first, which you have to do manually, naturally. It will take time, no doubt, but you have to do it on paper. Total of payments is this. Then closing balance is 84,000 for the month of April. Like that, for first month you have to calculate. Then what happens? The closing balance of April will become opening balance for May, naturally, right? Then what will be the closing balance there? keep working notes separately, don't mix that. So this is the main answer. So what is the closing balance there for the month of May? That could be this. But what the question said also is that firm will maintain only 20,000 cash balance. If at all there is any excess cash or deficit cash, excess cash will be invested, deficit cash will be taken as borrowing or selling the investments. So let us take this out. Closing balance 84,000, but investment will be how much then? Naturally 64,000. So that the closing balance is always 20,000. So naturally here always the opening balance has to be 20,000. There is no difference in that. That will be same. Only closing balance will change. So closing balance will be also 20,000, but before the investment closing balance will change. So now what is the May month end balance? 36,000. So 20,000 plus 88,000 minus 72,000, 36,000. Okay, that is the closing balance. But we need only how much? 20,000. That means how much has to be invested? 16,000 has to be invested. So still 20,000 is the closing balance. Same thing goes to next month opening balance, like that. Then what about June? June minus 2,000 is there. That means what? It is not investment. It has to be borrowing. Investment or borrowing. Investment is negative. Borrowing is positive. Okay. Outflow, inflow, simple. Borrowing, how much has to be made here? In order to maintain 20,000 closing balance, you have to borrow 22,000 because already negative balance of 2,000 is there. So that 20,000 final balance is maintained. Like that, for the next month, which is July, the closing balance will be 18,000. So you have to borrow 2,000. So that closing balance is still 20,000. Sorry. Then same way for August also, but August there can be a investment of 35,000, so that the closing balance is still 20,000. And in September 11,000 is their closing balance, which means you have to borrow 9,000, so that the closing balance once again is 20,000. So that is the cash budget for 6 months period. So it looks very simple. It is simple actually, but main point here is to know the collection from debtors calculation. This has to be done very carefully. One is the collection from debtors calculation. From the sales figures, those are given carefully. It has to be done. Payment to creditors also has to be done carefully. In this case, payment to creditors was easy. So directly we took 80% of the next month's sales. But still, finally, what is the amount that is supposed to be surplus or deficit? Is this how much of investment or financing has to be done? Investment or financing or borrowing has to be done. How much? 64,000, 16,000, 22,000, 2,000, 35,000, of course negative, 9,000. This is going to be the main answer. Of course, closing balances, opening balances will be always 20,000, since it is mentioned that the company always wants to maintain a balance of 20,000. That's it. That is how cash budgets have to be prepared from the data that is given in the question for multiple periods. Now moving to another illustration, that is illustration 7. From the following information relating to a departmental store, you are required to prepare for the 3 months ending 31st March 2020 month-wise cash budget on receipt and payment basis, like what we did just now. What method we used is receipt and payment basis only, that is month-wise cash budget. Second is statement of sources and uses of funds for the 3 months period. So the second one is like a cash flow statement, but we don't call it cash flow statement. We can call that as sources and uses of funds. So funds is the word used here. So what is that? Ultimately cash only. Logic of cash flow statement, if you remember, the same thing can be applied here also. It's not going to be something very fresh or new, but yes, it is named differently. Sources and uses of funds have to be prepared. We can call it a funds flow statement if we want, but particularly funds flow statement is not there as part of syllabus. So only preparation of cash budget in the fund format, we can call it. That is the second thing. That is for the 3 months period put together. First one is month-wise cash budget, and the second one is for the 3 months period. So second one is more of accounting type, though it is not shown as an account, but it requires the accounting knowledge. Of course, even the first one requires accounting knowledge of exactly identifying how much will be the receipts and payments. Now, what is that data which is available with us? It is anticipated that the working capital and other account balances on 1st January 2020 will be as follows. So here what was asked, first of all, for 3 months period it was asked, right? So January, February and March. These are the 3 months for which cash budget was asked, month-wise cash budget. Cash in hand and cash at bank was given originally at the beginning of January, that is on 1st January 2020 as 545. So let us take it as opening balance, that is there, 545, all rupees in thousands. You need to clearly mention that on the top right hand side while you write it, all rupees in 1000. Next, other things like balances are given, short-term investments, debtors, stock, creditors, trade creditors and other creditors. Dividends payable was there 485, tax due was there 320, plant was 800. These are the various items on which date, balance sheet items, all of them are balance sheet items on 1st January 2020. Now, budgeted profit statement is given for the 3 months, what we are preparing, January, February and March. This is the budgeted profit statement, not the actual but future profit statement. Sales is given, cost of sales is given, of course, gross profit. Then administrative selling and distribution expenses, net profit before tax. Then that's all. That is what is given. Tax and all is not given, but how much tax will have to be paid, that can be taken from the budgeted balances of various items which are already given. For example, on 1st January, there are short-term investments 300,000. On 31st January, they are going to be 700. How is it possible? It is only possible when you would have purchased 500,000 worth of investment. So like this, each of the items, we need to have item by item wise receipts and payments. Let us do that. Receipts, this is cash budget we are preparing. Opening cash budget, January, February, March. Opening balance already we have taken 545. Add receipts, whatever they are. Let us not take the same items. Whatever the receipts and payments come, as they come, we have to take. So there are naturally many items here. So let us take them one by one. Sorry. Now, one by one, if you take cash in hand and cash at bank, 545,000. So starting balance, opening balance, we have seen 545. Is that given for the projected items? Of course, it will not be given. Why? Because we have to calculate that. So starting balance only is given. We have taken that. Whatever we have taken that, let us mark them so that we know. Now let us move on to this. Short-term investments, 300. Short-term investments 300 at the beginning of January became 700 at the end of January, which means what? In January, there was outflow. You can call them receipts payment, you can call them inflows, outflows also, whatever the way it is. Finally, investment, short-term investments. How much happened in January? 500 happened. That is clear. Then, what about in March? In March, end of March again it became 200. End of March it was again, sorry, 300 to 700 it has become, which means 400 have been purchased. 300 to 700, 400 is outflow. From 700 it became 200, means 500 worth of investments would have been sold in March. That will be inflow. So short-term investments purchased is this, and short-term investments sold will be a receipt naturally. That happened when short-term investments sold, not in January, not in February. In March it happened. 500,000 worth of investments are sold. That is why it became 200. That's what we have to understand from that. Debtors, stock, trade creditors, other creditors. Other creditors, if you see debtors, stock and all, we have to look at them, because debtors changing happening itself means that will be showing us the collection from debtors also. For that we need sales, and we need to know how much are credit sales. So that has to be separately done in the working notes. Same logic applies to stock also, creditors also, both are related with each other. Then other creditors, if you see, there is no change in that. 200, 200, 200, we'll come to the other things later, but other creditors is 200, which means there is no change, means no cash flow. So let us just ignore that, or other creditors, all of that is covered. Other creditors, no further cash flow happened, just they remain same. Then dividends payable here at the beginning of January was also 485. At the end of January was also 485, means nothing was paid. Later it became 0. How? Suddenly magic? Definitely that means it would have been paid. So it is a payment. Dividends paid. So dividends paid. When is that? In the month of February it was paid, because even at the end of January also 485 was still outstanding. So in the month of February, how much was that? 485. So that is 485 in the month of February, payment that is. Then tax due at the beginning of January was 320, and at the end of January also, end of February also, end of March also, it was 320 only, which means nothing is paid. So just like other creditors, tax also nothing is paid. So no cash flow. Then plant, ignoring depreciation, this is the plant amount. On 1st of January there was 800,000 worth of plant, whereas at the end of January it is going to be 800 only, which means no purchase is going to happen now. But in the February, plant is going to be purchased. Purchase of plant, you can call it. In February, how much is that? 800 to 1600 it has become, means 800 worth of plant would have been purchased. That is purchase of plant. Then in March, what happened? 1600 became 1550. What does it mean? It means 50,000 worth of plant was sold. Depreciation and all not there. It is ignoring depreciation. This is the only cost of the plant, which means sale of plant. Happened in when? In March. That was 50,000. So that is about plant. All the things are done. Only things remaining are debtors, stock, creditors. These are the only balances which will have to be taken now. Now, looking at other information given in relation to the profit statement or income statement. Income statement has given this, sales amount is given, and cost of sales is given, and other expenses are all given. Now the point is, the question did not mention whether these sales are cash sales or credit sales. Not given means automatically we have to assume all sales are credit sales since nothing is mentioned about it, and debtors are there. So how to get collection from debtors when you have sales and you also have opening and closing balances of debtors? So normally, just for accounting understanding purposes, if you have a debtors account, let us say opening balance will be here closing balance will be here, right? That is debtors account. Then sales will be here. Naturally, what will be the remaining balancing figure? That is collection from debtors by cash. But we don't have to prepare accounts and all here. So what we will do here? We'll prepare it in a statement format. So what we have to take then? Opening debtors, add sales, deduct closing debtors. Or you can say sales plus opening debtors minus closing debtors will give collection from debtors. That has to be done separately in the working note. Let us take that separately to compute collection from debtors. January, February, March. So sales, first let us take sales given in the question, all thousands only, 2100, 1800 and 1700. That is sales. Add what? Add opening debtors. Opening debtors in the month of January is how much? That is given here. That is 2570. 2570 is the opening debtors. To be added. Then deduct closing debtors. How much is closing debtors at the end of the January? That is also given here. That is given here. That is 2600,000. So 2600, take it here. Automatically this becomes the opening debtor for next month. And what is the closing debtors for February? 2500. This 2500 will become the opening debtors for next month. What is the closing debtors for March? 2350. That's all. We have now collection from debtors. So simple logical thing. How to get collection from debtors is sales plus opening debtors minus closing debtors. We have collection from debtors. What will this be? This will be an inflow naturally. So part of receipts, you can put it there. This is collection from debtors. Sorry. 727069006550. Okay. So that is collection from debtors. That is done. So debtors balances are used, sales are used for that. Now coming to the other things, like for example, payment for creditors. For payment for creditors, we definitely need purchases. Purchases, how do we know? Purchases can be known only by looking at cost of sales and opening stock and closing stock. So we need to do two-layered calculation. Cost of sales is here nothing but opening stock plus purchases minus closing stock. What is that? Cost of goods sold. That's what is cost of sales in this case. So opening stock plus purchases minus closing stock is cost of goods sold or cost of sales in this case. But what we want purchases. Purchases is not given. Purchases has to be found out. How to get purchases? Naturally, it should be taken as cost of sales plus closing stock minus opening stock. That's it. So cost of sales plus closing stock minus opening stock will give us purchases. Same way, prepare another working note. Instead of sales, it is cost of sales. Of course, all the amounts will be different. Add opening stock. Sorry, add closing stock. Sorry, add closing stock and deduct opening stock. So that will give us what? Purchases. Okay. Copy paste from the data that is available. Cost of sales is how much? 1635, 1405, 1330. Put it there. 1635, 1405, 1330. Add closing stock. Deduct opening stock. So first let us take Opening stock of January, which is given here, that is 1300. We can place it at appropriate place. 1300 is the opening stock of January. So where we can keep that? Opening stock of January 1300. Sorry, this was wrong. This calculation we have to be doing like open sales plus opening debtors minus closing debtors. So this is the collection from debtors amount calculation was wrong earlier. To do that correctly on calculator, this should be the collection from debtors. Okay. Now it should be cost of sales add closing stock minus opening stock. So that will be purchases. But anyway, closing stock at the month of end of the month January, that is given here. So just we can directly copy paste that 1200, 1100, 1000. That is closing stock. 1200, 1100, 1000. And naturally the closing stock of January will become opening stock of February. So 1200. And closing stock of February will become opening stock of March. So what will be the purchases now? This is 1535, 3705, 3430. But these are purchases only. They are not payment to creditors. Once again, you have to refer back to the creditors. How to get payment to creditors? Just for convenience, creditors account if you prepare. We don't prepare that. How it will look like? Opening balance will be on the credit side. Closing balance will be here. Purchases will be here. So balancing figure will be creditors account at our two bank account, that is a payment to creditors. So what we need here, what is the equation that we need here? Purchases plus opening creditors minus closing creditors, isn't it? That's what is giving us the amount paid to the creditors actually. Purchases plus opening creditors minus closing creditors. So let us do that once again. This should be purchases we know already. 1535, 3705, 3430. Add opening creditors and deduct closing creditors. So opening creditors in January is how much? That is given here, 2110. Take that. Then closing creditors at the end of the month, each month, is given here, 2000. Stock is done. 2000, 1950, 1900. So closing creditors, 2000, 1950, 1900. But closing creditors of January will become opening creditors of February. Closing creditors of February will become opening creditors of March. I have to do it on paper. So purchases add opening creditors, deduct closing creditors. What we got? This is the payment to creditors really. That is the outflow. So payment to creditors, main calculation is this. Payment to creditors, 1645, 3755, 3480. That is the point here to be noted. And all the items have been covered as far as balance sheet items are concerned. Now income statement wise, sales we have taken, and from that we have derived collection from debtors. From cost of sales we found out purchases, and from the purchases we found out how much is the amount paid to the creditors. Real cash flow only we need. So these are all accrual concept items. We converted them to cash concept items. But in addition to that, there is expenses also. Administrative, selling and distribution expenses, 315, 270, 255. For sure, these are all outflows, expenses. But at the end of the question it is given, depreciation amounting to 60,000 is included in the budgeted expenditure for each month. Should we include that? Is it a cash item? No, it is not. So 315, 270, 255 minus 60,000 has to be taken for, minus 60 has to be taken for each month. So let us take expenses simply, or you can call them admin, selling and distribution expenses. So how much will be that each month? 315 minus 60, 255, 270 minus 60, 210, then 255 minus 60, 195. These will be the real expenses because only we have to take cash expenses. Depreciation is a non-cash expenditure. Done. That's all. All items are covered. Tax, nothing is paid because due is still the same. So everything is done. Now with this, we have got all the receipts as well as payments. So how much will be the receipts? Let us take them. Total of receipts for 3 months. Then payments. Total of them. You need to do it on calculator for 3 months. Then closing balance will be what? Naturally, opening balance of cash plus total of receipts minus total of payments. So that is a closing balance for 3 months. It will be the closing balance ultimately. Something wrong with payment to creditors maybe, because its amounts are too high. Let us check the calculations. Payment to creditors. No, something wrong with purchase itself. Yeah, these are not done here. Correct. So this has to be taken as cost of sales, add closing stock, deduct opening stock. Correct. So 1305, 1230. So now naturally payment to creditors will be different item. Yeah. So that is the cash budget. Purchase of investments 200. Okay. Correct. There is something wrong. Why? Because see, from 31st January, 29th February, there is a change here. Correct. That means what? In February 700 sold. That is why it became 0, right? Then again it became 200 later. So short-term investments, original balance was 700, 300, became 700 at the end of January. So naturally, short-term investments purchased is 400, no doubt, in January. But what happened in February? Short-term investments sold in February. Entire 700 sold in February, not in March. We have taken directly from January to March. In February, that sale happened. That is why it became 0. From 700 to 0 means entire 700 sold. Short-term investments sold in February. Then what happened in March? In March, again they purchased 200. That is short-term investments purchased in March. So that is one thing which has to be rectified. Looking at others, let us look at the amounts. 315 is correct. Second month looks like wrong. What about total payments? 2300, 2850. This is okay. 2850, okay. 1675 also okay. That is not a problem. What about receipts? Payments are correct. We have not taken the opening balance of cash in February. That's what happened. So in February, receipts are also might be correct. February closing balance of January will become the opening balance of February, right? So that has to be taken. Closing balance of February will become opening balance of March, right? That has to be taken also. Now this is correct. Yes. 315, 65 and 290 are the closing cash balances at the end of each month. So each of these items has to be carefully kept at respective places. After that only the calculations have to be done. Totals and other things have to be done later. So yes, it will definitely take some time on paper, no doubt. But with more practice and careful observation of each of the points in the question, definitely this can be done. So this is the 1st point. 2nd point, 3rd point, 4th point, 5th point, 6th point, 7th point, 8th point, 9th point, 10th point, 11th point, 12th point, 13th point, 14th point, 15th point, 16th point, 17th point, 18th point, 19th point, 20th point, 21st point, 22nd point, 23rd point, 24th point, 25th point, 26th point, 27th point, 28th point, 29th point, 30th point, 31st point, 32nd point, 33rd point, 34th point, 35th point, 36th point, 37th point, 38th point, 39th point, 40th point, 41st point, 42nd point, 43rd point, 44th point, 45th point, 46th point, 47th point, 48th point, 49th point, 50th point, 51st point, 52nd point, 53rd point, 54th point, 55th point, 56th point, 57th point, 58th point, 59th point, attempted well as scored also full. Entire 10 marks can be scored with that. But this question particularly was asking cash budget. To that extent, it's okay. But not only that, it has also asked statement of sources and uses of funds for this 3 months period. It is also asking that. So just like similar to, not exactly same, but similar to the cash flow statement. If you remember, same logic will be taken here also. First of all, you have to start with net profit. Whatever the net profit that is given in the question. What was the net profit given in the question? Means the budgeted net profit. 150, 125, 115. So all of them can be added because we are calculating for the 3 months period, not month wise. So 150 plus 125 plus 115. That is net profit. First starting point. Immediately, non-cash expenditure, depreciation has to be added back. That is each month 60,000. 3 months 180,000. So 60 into 3, 180. So this is net profit. Add depreciation 180. That is the one thing. That is the first point to be done because it is a non-cash expenditure. So this is first point, 180. Then whatever happened during this period in the form of sale or purchase of any fixed assets. What happened here? We know that already. Sale of plant happened in the month of March and purchase of plant happened for 800. So sources and uses separately we have to show. So let us look at the sources first. So in the form of sources, sale of plant can be taken. Which month we don't care, but the amount is 50. Then you will have other things like uses. Uses are what? Purchase of plant 800. Purchase of plant, that is 800. Then also dividends were paid in one of the months. Dividends were paid. When were they paid? In the month of February, but whatever it is, they are paid. That's a kind of financing activity, you can say. Whatever it is, you don't need to disaggregate. We are not preparing a cash flow statement. Similar to cash flow statement, we are preparing. But as dividends is an outflow, so that has to be considered as an application. Dividends. Dividend how much? 485. That is also application, or we can say use of funds. These are the major things. But in addition to that, if you remember the cash flow statement also, we have to do the adjustment for working capital changes. There we can do within the statement itself. But here in general, we don't do within the statement. We have to prepare a separate statement showing the changes in working capital. Statement of changes in working capital has to be separately prepared. Here, because we are preparing for 3 months, straight away we can take the opening balance of January and closing balance of March and see whether there is an increase or decrease. So this is called statement of changes in working capital. What is working capital? Simple thing. All the current assets, current liabilities have to be taken, copy paste. So what is the cash in hand and cash at bank? Opening balance at the beginning of January, closing balance at the end of March. Both, only those two have to be taken. Increase or decrease? Decrease. So add it here, decrease. Same with short-term investments. Originally 300, then they change it to 200. Final result. In between, a lot of things happen, but ultimately there is a decrease only. Debtors, starting balance 2570. There also there is a decrease. Stock, there also there is a decrease. So all of them are decreased. So these are all current assets which are all decreased. And what happened to the current liabilities? Current liabilities here have increased. Like that. You don't need increase or decrease for each of the items also. Actually, these two columns are also not required. Straight away, you can take total of current assets and then you take total of current liabilities. What current liabilities are there? Trade creditors, other creditors and tax due. So these current liabilities are there. So that is taken here as a total of current liabilities. Ultimately, working capital is how much, that is what matters. So 2085, 1420, net decrease is what? Working capital decreased 665. That is the main point. Working capital 665 was the decrease in working capital. Now you have to remember again cash flow statement. Decrease in working capital is inflow or outflow. Decrease in current assets, for example, is inflow or outflow. Naturally, inflow. So 665 has to be taken here as decrease in working capital added to the source of funds 665. So what are all the sources of funds? Here, net profit, add depreciation, add sale of plant, add decrease in working capital. These are all sources. And application of funds is 1285. Exactly, naturally, that should match. Sources and applications should match. Like a cash flow statement, where the ending balances of cash and all will match. Here, the total of sources and applications also will match. That is 1285. That's all. That is the other way of doing it. Of course, it is asked in the question to be prepared in the form of sources and application of funds or sources and uses of funds for the 3 months period, where we can start with the net profit as per the income statements, add non-cash items like depreciation, any other inflows from sale of plant or any other things like that can be taken here, which are non-current assets. Here it was there as a sale of plant. Purchase of plant will be application, and payments of dividends etc. will be financing activity. That is also taken here as a application or use. Main point is working capital change, because this chapter itself is working capital. Working capital change, how to take it? Starting balance, ending balance, take current assets, current liabilities, current assets minus current liabilities, that is enough. Individually current assets, current liabilities increase, decrease, not required in the exam, it will take too much time. Straight away, how much working capital increased or decreased? Decrease of working capital is inflow, increase of working capital is outflow. That's all. In this case, there is a decrease of 665, so that is taken as inflow. Then we'll get sources as well as application of funds equal. That's it. If you want to call this a funds flow statement, we can call it, but that's not the name it is given here. But still, it is the essence of it, which is similar, logic wise similar to what we prepare in the cash flow statements according to AS3. But here we don't need to follow any standard and all, only concept we have to definitely apply. Same type of concept. Main calculation here once again is statement of changes in working capital. You have to show that. It will take time, but you have to copy paste all the current assets and current liabilities, amounts, calculate working capital, then find out how much is the working capital changed. Increase or decrease, as the case may be. That is the preparation of cash budget, generally for the shorter period. For the longer period also, logic will be not going to be much different. Logic will be more or less the same. We'll discuss about how to prepare the cash budget for the long period with an example or an illustration in the next session. Till then, take care. Bye-bye. Thank you very much.